Talking about today the tax advantages of real estate. The goals of the presentation are to get a basic understanding of tax involving real estate, taxes on points on mortgages, closing costs and tax basis, deductions on real rental properties, home office considerations, capital gains, and I'm going to briefly touch on 1031 exchanges. So here are some basic tax terms. We have the mortgage interest deduction, which is real estate owners can deduct the mortgage interest they pay on their property, reducing their taxable income. Property tax deductions, these are property taxes paid on real estate. They can be fully deducted up to SALT, which is the state and local tax limitation, which is $10,000. Depreciation deduction, this is real estate owners can take advantage of the depreciation of their property, which can be used to reduce your overall taxable income. 1031 exchanges. 1031 exchanges allow real estate owners to defer paying taxes on capital gains made from the sale of property. A passive loss deduction. Real estate owners can claim passive loss if the property is generating a low loss and they are not actively involved in managing it. These losses can offset their passive income. There's a step up in basis at death. The inheritor of a property can receive new tax basis equal to their fair market value of the property at the time of death. So when you pass property by inheritance, it's a much better tax position to be in from the people who inherit. So your heirs are treated better. There's a rental income deduction. Real estate owners can deduct expenses related to renting out their property. Energy efficient home improvements tax credit. Real estate owners can receive tax credit for making energy improvements in their home. Investment tax credits. Real estate owners may be eligible for investment tax credits for historic preservation, low-income housing, and renewable energy products. Capital gains exclusions. These are very important. We want to have these. Capital gains. Real estate owners may be eligible for capital gains if they sell their primary residence. Some rules that are involved in that. You have to have 2 years of ownership within the past 5 years of sale. So it doesn't have to be continuous, and then you get $250,000 per owner up to $500,000. Points on the mortgage. Points on the mortgage refer to upfront fees charged by a lender to lower the interest rate on a mortgage. Paying points can lower the interest rate on a loan, resulting in a lower payment, but this means the borrower is paying more upfront in exchange for lower monthly payments over the course of the loan. Are points tax deductible on a purchase? Yes, generally they are. There are some conditions. Mortgage points are considered to be prepaid interest and are tax deductible as long as they're used to buy, build, or improve a primary residence. So there are a bunch of different points that you have to make sure that's true, but generally, yes, points are tax deductible. Now we're going to move on to closing costs. What are closing costs? They're the fees for buying and selling a home. There's the loan origination fee, the lender fee for processing the mortgage application, an appraisal fee, which is a fee for professional appraisals, a home inspection fee, a fee for the inspection of a property to make sure that it's up to code, that there's no cracks in the walls, or there's water seeping in, or mold, etc. There's a title search fee. It's a fee for researching the historic ownership of a property. This is done by a title company. There's title insurance, which is a fee for protecting the buyer against title issues. So you have title insurance that does their title research and then insures. A survey fee is a fee for professional survey. There's attorney fees, there's deed recording fees, adjustments, and escrow fees. For adjustments, these are credits either to the buyer or the seller for paid or unpaid bills. Could be water bill, could be a property tax situation. Those are one of the most common adjustments. Closing costs and deductibility. So closing costs that are deductible in the year that they're paid. So those loan origination fees or points paid on the purchase. This can be deducted in the year that they're paid. Points paid on a home improvement and a cash out finance. This is potentially could be deducted at closing. Private mortgage insurance. So your PMI has a potential. There is a phase out when you, as a single person, if you have over 54,500, it's a single file, and 109,000 as a joint file. So yes and no. Your FHA mortgage insurance may have some closing costs that are deductible in the year that they're paid. It has to be an amount that you can deduct. You'll find in box 5 of your mortgage tax form. Closing costs deductible. Some costs are deducted over the life of the loan as opposed to in the year all at once, which is points paid on the purchase. Portion of the points may still be deductible as long as you have the mortgage, points on home improvement refinance loans in cases where you used only a portion of your loan proceeds for home improvement. Any additional points can be deducted over a term. So if it falls into the home improvement refinance, you'll have an immediate deduction. If you use part of that loan for something else, then you have to extend it over the life of the loan. Not deductible, but can be added to the basis. So the cost basis is the purchase price. It measures capital gains when the property is sold. So you have a purchase price plus improvements can increase your cost basis. What goes into your cost basis? Your title insurance, your property taxes, only if you paid a share of the seller's taxes. So not the property taxes you're getting in the future. Title fees or abstract fees, legal and recording fees, survey fees, utility installation charges, transfer or tax stamps and taxes. You won't be able to add these to the basis if the seller paid for them when you bought your home. So just make sure you always check your closing statements or disclosure to confirm who paid what at closing. Not tax deductible, unfortunately. Homeowners insurance premiums, monthly principal payments to the loan, utility costs, money lost on a sale that did not close, home appraisal fees, notary fees, and document preparation fees. All of this should be in your closing statement. Just be aware. So when you have rental properties, there are certain other expenses that you can deduct. Your mortgage interest, property taxes can be fully deductible, not limited by SALT, if it is a rental or investment property. Repairs and maintenance, insurance premiums, these are fantastic deductions. You paid it out, it's for a business purpose, which is the rental, you're golden. Depreciation. The cost of the rental property can be depreciated over time. Advertising expenses, such as classified ads, listing fees. Utilities paid by the landlord, as long as they're used by the tenants. Management fees, travel expenses. We have to be careful with travel expenses. It's best to keep a log. So if you're going back and forth from building to building, on the side, you keep a piece of paper, a log saying on this date, you visited this property, came from this location, and it took you this many miles. So it can be deductible, but we have to be very careful. Legal and professional fees. So when you pay me to do your work, and furtherance of your rental properties, you get a deduction for that. Depreciation. Depreciation is something that's used to spread the cost of a tangible asset, such as a rental property, over its useful life. It allows the owner of an asset to deduct a portion of the cost from the taxable income, so it can lower your taxes. The idea is that an asset loses value over time due to wear and tear, becoming obsolete, or other factors. It spreads the cost of the asset over its useful life, and the IRS has tables to determine what that is. And that cost is offset against the taxpayer's income. Depreciation is a non-cash expense. This means it does not require the rental property owner to spend any money. It is a tax benefit that can be used to reduce the total amount of taxes owed. So it's a great benefit, depreciation. However, he who giveth with one hand also taketh away in another. So there's something that's called depreciation recapture. This requires individuals or companies to pay taxes on depreciation they have taken on as an asset when they sell it for profit. So they depreciate while you own it, and then there's depreciation recapture when you sell it. Depreciation recapture applies to assets that have been depreciated for tax purposes, such as rental properties or investment properties. The idea is that when an individual or company sells an asset for a profit, they have realized a taxable gain. The portion of the gain related to the depreciation taken on the asset is taxed as ordinary income at the time of sale. This is known as depreciation recapture. It's important to note that depreciation recapture is taxed at a higher rate than long-term capital gains, potentially, and may increase the overall tax liability. Having a home office can improve several tax advantages for individuals. Home office really is a great way of sheltering and minimizing your taxes, expenses. You can expense rent, mortgage interest, utilities, repairs, etc. as a business expense. There is the IRS can use a simplified method for calculating deductions, which is you calculate deduction by multiplying a rate of $5 per square foot of home office space for a maximum of 300 square feet by the number of days the home office is used for business, which could be every day, or could be a couple days a week. Home office can reduce self-employment tax, and it does give us increased tax savings. You can deduct things that you would not be able to deduct otherwise. It's very, very important to keep accurate records of expenses. So in any audit, the first thing they're going to do is ask for receipts. They're going to ask for invoices. So you want to make sure that whether it's a home office or any other type of expense deduction, you want to make sure you keep accurate records. Capital gains. In simple terms, capital gains is the profit you make from selling property for more than you bought it for. It's like finding a pot of gold at the end of the rainbow, but there's the IRS troll in New York State living underneath a bridge. You have to give them a piece of the action. It's the sale price plus improvements minus depreciation minus his purchase price. So here's something that's been going on since COVID, and people have been leaving New York and moving and selling and buying. Here's an example that we wanted to, that we should be aware of. In 1998, a husband and wife buy a two-family house for $100,000, and they use it all for personal use. In 2023, they decide to sell their house for $600,000. The sale price is $600,000. Their basis was $100,000. Their profit is $500,000. Since they've held the house and used it as their primary residence at least 2 years within the past 5, each husband and wife get a $250,000 exclusion. The profit was $500,000. The exclusion is $500,000. No capital gains. Everyone walks away happy. Something we found with people moving who have a two-family house where they rent one apartment and they live in one apartment. So one apartment consists of 50%. Now, what you do is you have to split up what is personal and what is business. On the personal end, their basis is $500,000, not $100,000. Their profit is $300,000. Their exclusion is still $500,000, so there's zero tax on the capital, zero capital gain tax. On the rental side, it's the same side. Basis is 50, which is 50% of 100, which was what they originally purchased for. The profit is split, $300,000 minus the basis of $50,000. Now there's a $250,000 gain. Surprise! Now you have a gain. So if we assume the capital gain rate to be 30%, and the person who's selling the home thinking that they had a zero capital gain, now they owe an $82,000 capital gain tax is what they have to pay. Or if they depreciated the property to zero, now they owe $100,000. They expected zero, but now they owe 100. That's a surprise, a big surprise, and a big hit to your pocketbook. So if you're in that situation, or if you know someone who does, just be aware before you make that sale. You want to go through what is your capital gain, and if you have depreciation recapture, very important. Very briefly, I'm going to go into 1031 exchanges. This basically takes the basis from one property, an investment property, and when you buy another investment property, instead of having a capital gain, it just moves the basis from that first property to the replacement property. It's tax-deferred exchange. It's when you invest and reinvest in like-kind properties. So the first step is your attorney and tax specialist sets up the 1031 exchange. The contract has to have the magic 1031 language, and you have to retain what we call a qualified intermediary. Step 2 is you go through the process, hopefully things go smoothly, and now you close. So when you close title on your sale, the net proceeds of sale do not go to you, it goes to the intermediary, and they hold it in an account. The third step is within 45 days of your sale, you have to identify and register and file the other investment property that you're purchasing. You can list a whole bunch of them. You don't have to close on all of them, but you have to list these other properties, like-kind properties that you are intending on thinking about closing on. And the final step is you close on that property within 180 days. This 180-day deadline are hard. You're off a day, you got beat. So within 45 days of the sale, you have to provide a complete identification sheet with the list of replacement properties to the intermediary. With 180 days, you have to close on one of those, or all, one or some of those listed properties. So if you identify a property or properties on the 46th day, if you close on the 81st day, if the closed property that you decide to purchase is not one of the listed ones that you listed on that sheet, if the sale or replacement property, so the property you're buying or the property you're selling is not an investment, you're not holding it to make money, and if the seller is not the same buyer, so if you sold the house as Stephen Bonfa and you're buying the house as the Stephen Bonfa Corporation, your failure is complete. You will not be able to take advantage of the 1031. Boot is capital gains that are from a 1031 exchange that is not deferred and it becomes taxable. So that's what we call boot. The amount of the purchase price less than the sale price is boot. So if you sold your house for $1 million and you're buying a house for 900, you will have $100,000 of boot. That's going to be taxed. Portion of the sale not held for investment. So if you've sold an investment property and you're buying another investment property and you're living in one of them, you're going to have some boot. You have to work out the fact of the figures. Portion of the replacement property not held for investment. So these are the stuff where you're going to have boot and it's going to be taxable. The good thing about 1031 is chaining the different sales and purchases. You can keep buying and selling investment property forever and keep deferring that gain forever, unless they change the rules. But as of right now, this is what we can do. Thank you very much for sticking with me. And as an attorney, this is my disclosure. We have to give it. This is just to inform you. It's not providing legal advice or tax advice. You should consult an attorney before making any decisions. And we cannot, past results does not guarantee future results. Thank you very much for your time. I hope this was informative to you. Please feel free to reach out to me. Here is my contact information, my phone, email. Go to my website. You can book an appointment, www.bonfalawpc.com. You can find me on Instagram and TikTok at Your Casual Lawyer. On the screen is my QR code, which will link you directly to my website. Thank you very much, and I hope you found this to be informative. Have a fantastic day.